This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to The Commercial Investing Show, where we analyze, explain, and exploit the opportunities presented in today's commercial property marketplace. If you're interested in apartments, mobile home parks, self-storage facilities, and other income property, you've come to the right place. We'll explore what's hot and what's not in markets nationwide in the relentless pursuit of return on investment. Here's your host, Jason Hartman.
It's my pleasure to welcome Matthew Gardner to the show. He is the chief economist at Windermere Real Estate. Matthew, welcome. How are you?
I'm very well, Jason. How are you?
Good. It's good to have you on the show, and we always appreciate getting a picture of the economy. That always looks different from everybody's chair. Just thought I'd ask you kind of generally, how do you think we're doing? It looks like we've been in a bit of a boom time. Some people are talking about the business cycle, and, aren't we due for a recession? I think we got a few more years, but what do you think?
Well, I took a position about a year and a half ago where I made the statement publicly that I expected we'd enter a business cycle recession likely around the end of 2019, early 2020. I'm still sticking to it, although certainly in the last couple of months, a lot of my fellow economists seems to have jumped on board with the same opinion. So ultimately, I think we certainly are due to have a recession, but we're probably a couple of years away, maybe a year and a half, possibly at the outset. 2 years before we have one.
Your company, Windermere, are you in about 10 states now? Or how
That's
how
correct.
Big are you? Yeah. Okay.
We have about 6,500 brokers in a little over 300 offices in the 10 western states. We're as far east as Denver and Fort Collins in Colorado, north up obviously to the Canadian border, down south to San Francisco.
Okay, fantastic.
Actually, San Diego.
Yeah, excellent. So you would be considered a sort of a Pacific Rim and Western U.S. type company. That's your main coverage areas, right?
That's correct.
Yeah, fantastic. Those mostly cover, I know that a lot of your offices are in higher end markets. I would call those the cyclical markets versus the linear markets that are kind of boring and don't make the news too much. But, you've expanded so much over the years. I'm not sure that's really true anymore. I know that's sort of your genesis. Seattle, where you're based, is certainly a very high-flying cyclical market. Do you kind of look at those distinctions of those different markets the way we do or not?
Well, I think so, yes. And if you look at the western states, certainly they are doing very well. I mean, our offices in Colorado, as well as in Utah, are doing remarkably well. And the further west you get, the more buoyant it becomes. Certainly, as far as the housing market is concerned, there's a lot more going on here than, shall we say, in markets like Michigan or Ohio, which I think is the statement they are somewhat linear, and I would very much agree with that. So we are very much, to a degree, in the boom-bust markets, which are pretty much all of the ones which we have offices in, other than maybe Utah. Utah seems to be remarkably resilient when it comes to downturns. They really don't have them.
Right.
But in general, yeah, I think the western states are the ones which do tend to see more peaks and troughs, certainly when it comes to the housing market, than the Midwest or even the parts of the East Coast as well.
Right. That old saying, the higher they fly, the harder they fall, might be somewhat appropriate in that discussion. But there is this amazing, really tragic shortage of inventory. The new home builders, the last time around, they were building entry-level housing before the Great Recession and even into it a bit, but they just haven't built that kind of product at all, and they're building higher price product. What is going on with new home development? I know construction costs have risen dramatically. Is there going to be any break in the inventory shortage?
That's certainly one of the questions that I probably get asked more than any other, at least other than, is there another housing bubble? But we might get to that a bit later on. But in terms of new construction, certainly, I mean, the intuitive view would be, if we have a lot of pent-up demand, which we clearly have, why aren't builders building more? Quite frankly, you have to look at the four corners that I call them of new construction development. And those are land, labor, materials, and regulation. Mm-hmm. So if you run through those kind of very quickly, land, certainly in the western states where we have a lot of geopolitical constraints, and those would be the creation of urban growth boundaries, i.e. markets where you can locations you can build, and outside of those boundaries, areas you really, quite frankly, can't build. We've seen a big push up in the cost of land, and that is something which is coming into play more now, I would argue, than I've seen the last 28 years. So land prices have been going up. Secondly, labor. There's an awful lot of construction workers that were building homes back before the recession started. They've got out the market. They all disappeared off to the Dakotas and went fracking. And unfortunately, those employees have not come back into the housing market. On top of that, obviously, recent immigration reforms have caused a contraction in the number of people in building. So when you see that happening, we have a lack of labor. That, again, forces prices higher. Materials doing the same thing. They're going up, quite frankly, at about 0.5% per month right now. Tariffs that are imposed on Canadian softwood lumber haven't helped at all. So you're seeing the cost of materials go up. And finally, regulation. Regulatory costs account for about 25% of the cost of building a home. So it's remarkably high.
Wow. I'm so glad you mentioned that, because I have not heard it expressed that way before, or at least not that high. And that varies quite a bit by area, doesn't it? When you say 25%, I mean, a quarter. Folks, listeners, think about what he just said. 1/4 of the cost of the home you buy is regulatory. I mean, those are pass-through costs from the regulatory burden. So if you buy a $400,000 property, that's $100,000 to pay for some sort of regulatory issue, whether it be OSHA or environmental or whatever. But feel free to elaborate.
And all the way down to permit fees. Everything you said is very accurate. So sewer and water hookup, infrastructure, and all these fees come under regulation. So my point being is that if you imagine a builder who's looking to build a development, he is going to throw in those costs: the land, labor, materials, regulation, obviously, and to add on to that debt service, and that will spit out a number, and the number that he needs to sell the house for in order to make money. Well, imagine hypothetically if that number is $600,000, yet the market acceptance price point is $400,000. Is the builder going to build or not?
No, they're not.
No, they won't.
Right.
Exactly. So because of that, right now we're building about 900,000 single-family homes a year. I would argue there's a shortfall today of at least 200,000.
Wow.
So we're certainly not even coming close to building what we need to build. In addition, where we have a lot of robust demand is in that first-time buyer price point.
Yeah.
And that's even harder for the builder to do.
Right.
So not only is it very expensive to build, they're not necessarily building the product that the market wants.
Yep, that is something else. It really is. So what do we do? I mean, do we just expect no relief from this at all? We'll just see higher and higher prices because of the inventory shortage?
Well, I think ultimately what's going to happen, it's very difficult to take the price off the land, because ultimately a land seller, that's a price he wants to achieve. If he doesn't get it, he won't sell. Labor and materials, again, you really can't change those. So the only thing you can do ultimately is look at regulatory cost and find out how feasible it is to get that reduced. Mm-hmm. Now, it'll be a big problem. It certainly is one. Do I expect an easy solution? No, there really isn't. But at some point, jurisdictions, cities, counties, states across the country really need to come to terms with the fact they can't turn around and say to builders, we have a rabid shortage of affordable housing, fix it. Well, we need their help. Mm-hmm. And ultimately, I think that will likely come from changes in regulation, but I'm not holding my breath.
Yeah. And these regulations are mostly at the local level, right? I mean, the
yes,
stuff that's baked into the cost of the materials, you're not including in that regulatory burden. That's strictly the local or state level. For example, if the producer of the lumber or the concrete or the nails or the glass or whatever, the ingredients of that house, the petroleum products, that regulation isn't being counted in that 25%. I assume, right? Because they've complied with all that regulation before the builder bought the raw materials, right?
Yeah, and you're absolutely right. Yeah. So the regulatory costs which goes to the cities and the counties for the better part, those other permit fees, the water sewer hookup fees, they are nothing to do with associated fees with materials. That's totally separate.
Mm-hmm. Yeah, wow. That's something else. That's really amazing. It really is. And it varies a lot by locale, too. Okay, so we've looked at the construction stuff. What about millennials? This is the largest demographic cohort in American history, slightly larger than baby boomers. And they're really a different kind of group than millennial group, the Gen Y group.
That is true.
Yeah. They're not like my generation, Gen X. They're not like the baby boomers. They're not like the maturers. What do we make of this group? I say that they're delaying home ownership. They're delaying family formation. They've got these huge student loan burdens. I like to say that they've got a mortgage. They just didn't get a house included with it. That's called their student loan. But, because they're so large, some of them are certainly buying, and that is impacting the market. They are finally moving into the housing market. And, 80 million people, even if a smaller percentage of them are buying, it's still a significant impact. What do you say about the millennials?
Well, I think you've nailed a lot of it right on the head. Yes, they are by far the largest, by about 5 million. There's 5 million more millennials now are baby boomers. But I think there's several things which are important to look at, one of which is, there's certainly a very interesting demographic to look at, but we need to kind of get away from the normalized argument that is, that they spend their life eating avocado toast. That isn't necessarily
for $16, yes. Right.
Yeah, exactly. And as you said, the oldest millennials are now in their early to mid-30s. They've grown up. And so are they buying homes? Yes, they are. But the different things you mentioned are actually very appropriate, one of which is they are lumbered with an extraordinary amount of student debt. Outstanding federal student debt today is at about $1.5 trillion. So think about it in these terms. Trillions is a huge number. If you take all of our credit card debt as a country, it's about $850 billion, give or take. We owe a third more on student loans than on our credit cards.
Wow.
And the kicker is this. File bankruptcy, your credit card debt goes away.
Yeah, you can't do it with student loans.
It does not, exactly. So one of the issues they have, beyond the normal of not being able to afford their avocado toast, is the fact that they're having a very hard time saving up, getting a down payment to buy a home. Mm-hmm. Yeah. Now, about 25% today are still tapping on the doors of the bank of mum and dad. So approximately 1/4 are actually getting the down payments from their parents. But that's becoming more difficult. Back in the day before the recession, a lot of families would tap into their home equity lines of credit, these kinds of things, to help out their children. Obviously, with recent tax changes, they are more or less likely, shall we say, to do that than they used to be. Mm-hmm. In very high rental rate markets, the quandary they have is, do they pay the rent or do they save up for a down payment? They can't do both.
Mm-hmm. Yeah.
So that is another issue. And so they're really kind of stuck in a situation whereby they're almost forced renters for the better part.
Yeah.
So down payment's a big issue, certainly very much so in the coastal cities, San Francisco, LA, well, also Seattle, to a degree, Portland, but even on the East Coast, New York and Miami, these are expensive markets. Now, do they want to buy? Absolutely. About 68% of them believe that buying a home will be the most astute financial investment they will ever make. But 74% think they can't qualify for a mortgage. Mm-hmm. Yeah. They would also, so what's interesting is kind of where do they want to buy? They're moving out of apartments, as you mentioned very accurately a few minutes ago. The household formations, they are actually growing up. They are creating households. They are getting married. They're having less children, by the way.
Right.
They're doing things that our generation did, but they're doing it about 5 to 7 years later than we did it.
One of my millennial friends, I've just got to share something with you funny. Of course, you and probably most of my listeners have heard this term that the millennials have coined. They call it adulting. Adulting. And one of my millennial friends, she texted me the other day and she was complaining about how she needs money. And she says, this adulting is difficult.
Oh, very much so.
Welcome to the club.
Yeah, exactly, as to why that is. There's a generation no one said no to and these kinds of things.
Right.
But no, it is remarkably hard. However, they certainly want to buy. Now, here's the interesting thing I'm seeing certainly in the Pacific Northwest. And that is the fact that when they do move out of their urban apartments, they do not want to move into the suburbs. Mm-hmm. Yeah. They would like to move ultimately into what I define as being ex-urban markets. Right. They'd like 1 foot in town, 1 foot out.
The exurbs, yeah.
Yeah, townhomes are a very big thing for them. Mm-hmm. Anywhere 12 to 1,500 square feet is perfect for them. Mm-hmm. Now, The issue is in many markets, and certainly Seattle and Portland and the Bay Area very much so, is the fact that they can't afford those. Townhomes, which we're seeing traded in that $600,000 to $900,000 price point, which is essentially what it is, certainly in the Northwest, it's almost actually now forcing them out further into the suburbs.
Sure.
And additionally, as I mentioned earlier on, builders just aren't building for that demand, for that price point. That's problematic for them, even if they can afford to buy somewhere. What is out there that they can afford to buy?
Right. The $1 million question is the one you alluded to a few minutes ago, and kind of shifting gears a little bit, but not completely. Is there a housing bubble? And you just said $600,000 to $900,000 first-time home for millennials. Oh my God, I think that's so absurd. I can't even repeat it almost. I mean, they should be buying a $150,000 home, But the world has changed.
The trouble is the land's worth $150,000, let alone before you even put a house on it.
Right. And of course, it depends where you are. It's very much about location. But the banks, it feels like the banks have been pretty conservative this time around. I see little glimmers here and there of, low down payments, but the liar's loans aren't here. I mean, if we have a housing bubble, is it going to be caused by a mortgage crisis, a foreclosure crisis? I just can't imagine that this time around, because the banks have been pretty staid, it seems.
You're absolutely right. I think it's interesting to let's think back to the halcyon days of the early 2000s, where essentially, have a heartbeat, get a mortgage. Mm-hmm. It really was not that difficult at all, and that certainly is what drove the housing bubble. We've essentially moved from the sublime, everyone qualifying, to the ridiculous, no one qualifying.
Right. They've overcorrected. They really have. Very,
very much so. The average FICO scores on an approved loan last month were about 742, I believe.
Right.
So very, very high. Mm-hmm. The average FICO score for a denied conventional mortgage was 700.
Wow.
So even a credit score of 700 denied.
Won't get you a mortgage. Wow. I hate to say it, but that's ridiculous. I mean, there are a ton of 680 borrowers that should get mortgages, if you ask me. I mean,
I think you're right, but here's the kicker to that statement, though, Jason, and that is, let's say we drop down from 740 to 730, hypothetically. Well, that would essentially mean one thing. About another million households would then qualify for a mortgage. I don't need any more demand. Mm-hmm. I haven't got enough supply of houses as it is.
Exactly.
So by lowering it, all it's going to do is going to, again, further overheat the housing market.
Yeah, good point.
Are we in a housing bubble? Absolutely not. And as you said, credit quality is remarkably high, and that's essentially a function of Dodd-Frank, or it was. Mm-hmm. And so I'm not seeing that changing. Down payments are also considerably higher than we've seen in a very, very long time. Mm-hmm. So when we look at it in those terms, right now we're sitting on about $15 trillion worth of equity in our homes today.
Right.
So down payments are high. We haven't really added on to mortgage debt. Basically, the same amount of mortgage debt we have now as we had back in 2009, give or take. So that hasn't gone up. Home prices have. So the value of housing in America today is about $25 trillion. We have about $15 trillion of equity and about $10 trillion worth of debt. So we have a very substantial cushion underneath us in case something goes wrong individually. But the way I look at housing bubbles is essentially twofold, two big things I look at. One of which is credit quality. Well, obviously that's very, very high. Down payments are very, very high as well. So that's not an issue. Secondly is, are we seeing as much home flipping that we saw back before the recession?
Right.
And that's it's basically speculative purchases and people buying, renovating, and flipping. That's actually continued to decline.
Yeah. Well, one of the reasons many speculate that the home flipping has declined is because just this lack of inventory and increased construction cost. They can't make the margins work. I mean, we see it with our own providers. They are struggling to make the margins work. And, I have this discussion with them and I say, well, just raise the price. We can't. The appraisals won't come in. So it's like this catch-22 that they're in. They can't get the appraisals because the banks are too darn conservative, or the appraisers, I should say, to be more direct about it, and they just can't make the margins. So the example you gave before about the developer, the flipper is the same as the developer, really. If they can't make the money, they're not going to do the deal.
And you're absolutely right. And if you think about it, if they're looking to flip, or even if they're looking to buy a home which they're going to use as a single-family rental, if they're borrowing money against it, then the expected rental rate return, again, is not going to be sufficient. There's not going to be enough yield. So I think in both respects, credit quality being high, lower flipping activity going on. The loan-to-value ratios that I'm looking at right now, which is basically the value of the housing relative to the loan, is around 40% again, which is, again, essentially the long-term average. Mm-hmm. And to give you an idea, back when the housing bubble burst, it was up at about 65%. Mm-hmm. As long as that line is coming down or still flatlining, these are the indicators I look at relative to a housing bubble, and I'm just not seeing them. So I think our next contraction, our next business cycle recession will absolutely not be driven by the housing market.
Yeah, couldn't agree with you more. I couldn't agree with you more for all the reasons you mentioned. So what will it be driven by? Care to speculate on that one? Cryptocurrency bubble, student loan bubble, auto loans?
Auto loans, believe it or not, is something which I do worry about.
Yeah, I do too.
We're seeing default rates on car loans continuing to escalate.
I agree.
There's a couple of things that could drive it, one of which, unfortunately, the potential for trade wars. Mm-hmm. No one wins a trade war. President Xi from China made that statement several months ago. I agree with him. I think if we continue this isolationist policies coming out of our federal government, that could do it. Now, there are other things you need to look at as well. I think if we continue to see, or if we start to see, faster tightening by the Federal Reserve in terms of normalizing interest rates, if they do that too quickly, that could certainly achieve the same end and create a contraction. Mm-hmm. But I think ultimately, you mentioned the R word, the nasty recession, and everyone obviously thinks back to 2008. This one, I think, is going to look very different. It's going to look like a more normalized business cycle recession. What do I mean by that? It'll look a lot, I think, like the 1991-92 recession. Right. It'll last 2 quarters. Unemployment rate won't rise above 6.5%, which essentially means that home prices will not go down. They'll flatline, but they won't go down. This country's had 47 recessions in its history. It will have 47 more.
Sure.
Business cycles happen.
Yeah.
So I think that a lot of people need to be prepared for it, but don't necessarily need to think of it as being another housing bubble, great recession that we saw back in 2008 through 2009.
Great point. I agree. That was a once in a lifetime or twice in a lifetime thing. We had the Great Depression, and then 7 decades later, or even a little bit longer, we had the Great Recession. So those were Correct. Anomalies. Those were huge events, obviously. But do you have just a moment? I know we've got to wrap it up. Just a moment to unpack the trade war statement. You mentioned nobody wins a trade war. How does the trade war, if you unpack that a little bit, cause a recession? I see that it makes prices go up. It makes supplies decline. It causes less consumption. And,
Correct.
When 72% of your economy is based on consumption, then you have a recession by reduced consumption. Is that it?
Yeah, and you're absolutely, and your numbers are absolutely right. How do we define recessions? We define recessions, technically speaking, as a 2-quarter contraction in GDP. Now, GDP, gross domestic product, is the value of goods and services that this country produces. And if that turns negative for 2 quarters, that actually technically equates to a recession. So imagine if we start imposing tariffs on all these other countries, Europe and Canada, Mexico and the like, and Japan, then it's likely that they will impose similar tariffs. So by doing that, that will then slow down the amount of goods that we will be producing to sell overseas, because the price overseas is going to go up by that much more. As that happens, companies will then look to slow down their production, potentially contract their employment base. That's kind of ultimately where it could go at a worst-case scenario.
Yeah, very interesting. Give out your website and tell people where they can find out more about you and your work. And, if you want to mention anything on interest rates, that's sort of the one major area we didn't discuss. Before you go, wrap it all up and we'll let you go.
Oh, sure. There's a couple of things, one of which I know
it's a minor detail, interest rates, but,
Briefly, I know you mentioned about apartments, and are we going to continue to see apartment rentals rates continue to rise?
I think we will.
I expect that's going to slow down.
Yeah.
I think it's going to slow down because the supply-demand imbalance we were in is essentially getting back into balance again.
Right.
I think that any viewers or listeners of yours who are renters expect, depending on where in the country they are, that we will see slowing rental rate growth, just as we bring on a lot more supply.
Just maybe you want to distinguish that, though. You really refer to apartments. I mean, look at every major American city has had cranes in the sky for years now, and they've been building institutional apartments for years. But in single-family home rents, I think that supply is still very constrained. I mean, that hasn't been oversupplied at all. So rental rates there probably pushing up, but apartments softening, right?
They are, but there's another little tweak to that as well,
Okay,
Jason.
go.
And that is a group that I define as being called, I call them Boomerang Buyers.
Mm-hmm.
And who are these people? These are people that lost their homes to foreclosure back in 2008, 2010, whatever it was. As of this year, the early ones that lost their home to foreclosure now qualify to get a mortgage again.
Right.
They are going to start moving out of rented accommodation, and they're going to buy again.
Yeah,
So I would argue ultimately that the aggressive rental rate growth we've seen in single-family rentals is likely to start tapering.
Well, that's an interesting point. At the same time, though, you have the millennials moving into the market more. So we'll see. That's an interesting point. Yeah, they can qualify for mortgages, but you see higher prices because of this additional demand, right, of the people able to qualify, ultimately push rents up because, it's a rent-to-value ratio, ultimately. But, interesting.
And it is, but it's something which I think that where we've seen a lot of aggressiveness relative to people buying speculatively, buying homes to rent them out. What we are certainly seeing in the greater Seattle market is that demand is still solid, but the rental rate growth we've seen for the last 6-9 months has absolutely started to slow down. So that's where I expect to see that going.
I agree. In Seattle, the rent-to-value ratios are totally out of whack because it's just such a booming, that market's been booming for so long now. It's absolutely crazy. But,
very much so.
Yeah. Well, congratulations for being in it, though. I'm sure you've done well.
We are certainly doing well relative to a lot of parts of the country. But if I worry about one thing, what's the one thing that keeps me up at night? It is housing affordability.
Yeah, no question about it. Because it's very low.
If you can't provide housing for all income cohorts, the way I look at it is to imagine that you are the owner of a company. You're thinking about expanding into Seattle. What are the two things that you think about most? Well, those are going to be, one, is there a talented workforce?
Right.
Are there people out there that I can employ?
And you've got
we're very lucky in Seattle.
Yeah, right.
Yeah, we're smart, so we're very lucky. But the second part of the equation is, how much do you have to pay people?
You got to pay them $200,000 a year to afford a home in Seattle, so, yeah.
Right, So, we're in a situation right now whereby, and of course the biggest component of salaries is cost of living. So, i.e. shelter.
Yep.
So at some point, we're not there yet, but at some point companies that are thinking about being here will say, wow, I just can't afford it.
Yeah.
So they're going to start looking at other markets, which is why we're seeing a lot more interest east in Washington, Spokane, for example. Right. We're seeing a lot more interest in Boise, Idaho right now. At least Boise's building homes, which is a good thing. Many markets aren't. So I do fear if we cannot address the affordability issue, then the market up here, just in aggregate, is going to start becoming less competitive. And that is a concern of mine.
Yeah, I applaud you for being concerned about that. This is exactly what happens. Money is like, I call it the water theory of money. You spill a glass of water and it flows to the lowest point. And so money seeks out those lower priced tertiary markets. And that's what it always does. It has to.
Absolutely.
Because they're so constrained. Give out your website. Did you do that already? Just want to let you wrap it up.
You go to windermere.com/economics. You'll find all kinds of good stuff there.
Excellent.
I'll certainly be happy to answer any ancillary questions that any of your listeners might have.
Matthew, thank you so much for joining us. It's been a fascinating discussion, and we'd love to have you back again on the future. Matthew Gardner, thank you so much.
You're very welcome, Jason. Thank you again.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.